This is Covered Calls with Kevin Simpson, featuring expert insights and analysis from the industry's top investment professionals. If you'd like a deeper understanding of today's markets, this is the show for you.
Gary, thank you so much for coming back on the podcast. The reason I wanted to have you on at this critical time is so that our viewers, who are mostly financial advisors, can understand the dynamic of active management. You know, you and I talk about this all the time, and I really wanted you to share your thoughts in this open forum. So let's get right to it. Why is active management so important today, Gary?
You know, well, Kevin, it's in the year that we've just had, advisors, and especially advisors who have the task of, you know, speaking with clients and front-facing with clients, have to recognize that when you look at a year like this year, and you have to index and you have to own everything, it's really the stocks that you don't own because you don't have to own the index that creates the relative outperformance. The S&P is down, NASDAQ is down, but the value add in a market like this is not what you own as much as what you don't own. And that was the case, obviously, in 2000. That was the case in 2008, 2009. And again, as we're now entering the end of the year, advisors who are doing a great job are speaking to their clients, recognizing that we're in a very different world than we were 12 months ago. And then you've got to make a decision with your clients what the outlook is for the next 12 to 18 months. And I sincerely believe that, much like the periods I just discussed, Kevin, and you and I have talked about this quite a bit, as the Fed continues to raise interest rates, despite what we got from CPI earlier this morning, inflation is still north of 7%. The Fed is going to end with a terminal rate somewhere around 5%. What you don't own in clients' accounts is going to be much more important next year than what you do own. And so it's very important to recognize, if you want average performance and you want index performance, buy the index. That's not going to work in 2023.
What would you suggest financial advisors do to take advantage of the way markets have moved heading into year end? Maybe if they own index funds that could potentially be giving capital gains distributions, that hasn't happened since 08, 09, but are there steps that we can take now before the end of the year to position for 2023 and beyond?
Well, definitely. The first and most important thing is knowing your client, obviously. So it's a taxable account or a non-taxable account. That's the first thing you've got to focus on. In the non-taxable accounts, capital gains, irrelevant. In the taxable accounts, where you might have put money into an index fund earlier this year, and you've got the short-term capital loss, it's much more advantageous to recognize that loss and look for an active management strategy. As again, I think the relative performance of 2023 is going to be so significant. But even with individual stocks where you may be thinking about a tax loss and maybe a 30-day wash sale rule, the important thing is to recognize that this is the time of year as an advisor that you are valued by your clients, recognizing that taking a loss sometimes is as important in long-term wealth creation as taking a gain. That might sound a little crazy, Kevin, but history shows that when you keep your winners and you sell your losers and you allow the winners to run, that's where the great compounding of wealth creation occurs. So what I would suggest is have the conversations, recognize the losses, understand that 12 months ago, when the Fed was telling everybody inflation was transitory, having an index approach might have been the most efficient, cheapest. As we know, most active managers aren't able to beat the market. It might have made sense. We're in a different world now. We're in a world where companies that generate free cash, that return that cash to shareholders, is the single most important factor in a rising interest rate environment. So omitting companies that need the capital markets in order to grow their business, that need access to debt financing in order to run the business day to day. These type of businesses are the type of companies you don't want to own. So being in the index will give you, again, not to be repetitive, but to hammer home the point The index will give you the index returns. The relative outperformance next year will come from active management, avoiding those securities, and identifying the companies that don't need access to the capital markets to grow their business.
Sounds like our enhanced dividend income portfolio in Devo is pretty well positioned with a little wind at its back these days.
Well, absolutely. The discipline of owning companies that generate free cash in a cycle like this is appreciated. Long-term investors know it's always appreciated, but periods like we had in April of 2020, when the stimulus was being, incremental stimulus was being supplied, both monetarily and fiscally every day, we get to periods where that type of security investing is I don't want to say diminished, but sometimes overlooked. This is a period where free cash flow, returning that cash flow to shareholders is paramount. Maybe it's a good time, Kevin, just to refresh. You and I have talked about the 5 pillars, sometimes 6 pillars of what companies can do with money. And I'm happy to review it. If you want to review it, it's probably the single most important conversation advisors could have with clients right now, recognizing that they are recognizing the changing dynamics.
Gary, if you could just run through those pillars. I know we debate whether it's 5 or 6, but it's really important for advisors to understand what companies can do with cash and how we perceive it in our portfolios.
Yeah. Well, again, let's just go back. The historical rate of return in equities over the long-term cycle is somewhere between, let's call it 8 and 10%, with dividends reinvested over the cycles. 2/3 of that are dividends and distributions reinvested, not capital gains. So if a company generates cash, they could basically do 5 things, in my opinion, with the cash. They could do nothing. And historically, those are the companies that have the worst relative performance. They can do M&A, which is great, by other companies, by the businesses, but 9 out of 10 times, there's no value added because cultures clash, products don't mesh in terms of sales and distribution. And so the likelihood on a percentage basis is 1 in 10 that a merger or acquisition could add value. So then you get to they could do nothing. Okay, they could do absolutely nothing with the cash, which is the worst thing to do. So if do nothing is the worst thing to do, M&A doesn't give you a high probability. Then you can basically buy back stock, which is sometimes contingent on the markets itself. And so buying back stock is better than doing nothing. But the 2 best things that a company can do is use the cash flow to grow their own businesses organically. But not every business has the ability to grow organically. So the history shows that companies that have a disciplined dividend and distribution, recycling to shareholders is the best use of long-term capital, free cash flow, because that is the most certain thing you can. Cash in the shareholders' hands to be reinvested or to be redistributed out is the best use of cash in the cycle. And when we're in a rising interest rate environment, possible recession, Fed tightening cycle, and even if the Fed, as I heard many pundits talk about today, even if the Fed sits on 5%, let's call it for 9 months before they start to ease again into the next cycle, in a muted Fed funds rate with interest rates higher than the normal average, you want to be invested in companies that return that cash to shareholders. Sometimes we try to complicate things, I think you and I spoke about it last month. The first thing you learn in money management, and every advisor out there that's listening to this knows, the first thing you're told is don't fight the Fed. So why do we try to sometimes overcomplicate things? We know what the Fed is saying they're going to do. Despite CPI today, we know where inflation is. We know that they want core inflation to get below 2% long term. So you want to be invested in companies that have the ability to generate cash and return the cash. Don't make things more complicated. If you want to invest in the index, that's great. This is not the time for index investing.
So the free money trade is over. The zero interest rate environment is over, and active management once again takes front and center. Gary Kaminsky, thank you so much for your time today. couldn't be more delighted for the friendship that we've grown into. Your mentorship is so valued and cherished. Thank you for your time, and thank you for sharing your thoughts with our financial advisor community.
Absolutely, Kevin. Thank you.
This message does not constitute an offer to sell or a solicitation of an offer to purchase securities through Capital Wealth Planning. Investment success is not guaranteed and involves risk of loss. Gary Kaminsky is an advisory board member at Capital Wealth Planning, LLC. No part of Gary's compensation from Capital Wealth Planning is related to the specific opinions he expresses in this podcast. The views and opinions expressed in this message are Mr. Kaminsky's, made at the time this content was recorded, are not necessarily the views and opinions of Capital Wealth Planning, and may change in time without notification. For additional information about Capital Wealth Planning, visit CWP's or the SEC's website, available at the website address below, for a copy of our ADV disclosure brochure and Form CRF.